They keep telling you the stock market is strong, while your rent feels like a second car payment and your grocery bill's punching you in the mouth every week. At the same time, every other headline screams about recession, layoffs, and the next 2008. So you look at the charts, all-time highs, tiny pullbacks, then new highs again, and you think, how has this thing not crashed yet? Before we go any deeper, remember this is not financial advice. This video is for education and entertainment. Every investment carries risk, nothing is guaranteed, and you should always do your own research before making decisions. Now, why talk about why the stock market has not crashed yet right now? Because if you do not understand why it is still floating, you have no chance of understanding what happens when gravity finally shows up. You could be the machine wants you scared at the wrong time and relaxed at the wrong time. If you can see how they are holding this thing in the air, you can flip the script from victim to prepared shopper when the sale finally starts. Let us start with something most people never see. When you zoom out a few decades, the stock market looks like a staircase. Lots of ugly steps up and down, but the general direction is higher. Someone who dumped money in at the worst time in 2007 or at the dot-com peak in 1999 still ended up far ahead if they simply stayed in long enough. The crashes felt like the end of the world up close. But from 20 years away, they looked like potholes on a long highway. The weird part is what happened in early 2020. In February and March of that year, the market did something it had never done before. In a few weeks, the S&P 500 fell from record highs into a full-on bear market at record speed. Then, just as fast, it turned around and rocketed back to new highs within months. That is not normal. That was not free market healing. That was the machine. Ever since the financial crisis in 2008, the people in charge realized something. When things break, they do not have to sit back and let the market clean itself up slowly, like in the Great Depression. They can slam interest rates down to near zero, buy bonds with newly created money, and flood the system with cheap credit. So instead of a long, grinding reset, you get a violent crash, and then a V-shaped rocket ship. Asset prices levitate, stocks bounce, real estate inflates. On paper, everything recovers. But it is not free. You see the bill in your daily life. Rents climbing, house prices jumping by 20 or 30% in just a couple of years. Basic stuff costing more even when your paycheck barely moves. That is what happens when trillions of cheap dollars chase the same number of homes, the same number of groceries, the same number of used cars. So why has the market not crashed again? First reason, we are still living in the echo of that cheap money decade. For more than 10 years after 2008, money was basically on sale. Near zero interest rates became the background noise. Companies could borrow for almost nothing. Governments could roll over their debts without feeling the pain. Consumers got used to low mortgage rates, low car loan rates, and free installment plans on everything from phones to furniture. That cheap money poured into the stock market. Tech giants, index funds, and buybacks turned into a constant buying machine under prices. Even after the pandemic crash, every rescue package and every near-zero rate cut told investors the same story. If anything big breaks, we will step in. So the first reason we have not seen the big crash is simple. People still believe the machine has their back. The second reason is psychological. Most regular people are exhausted and cautious, but big pools of money are still chasing returns. Pension funds, insurance companies, and huge asset managers cannot sit in cash for 10 years. They have to be in something. So as long as the economy is not in a full-blown depression and companies are still reporting profits, that river of institutional money keeps flowing into markets by default. Your monthly retirement contribution, your employer match, all of that is automatic buying pressure. The third reason, there is still a lot of hope priced in. Hope that inflation will cool without destroying jobs. Hope that central banks can cut rates again without triggering another runaway bubble. Hope that new technology and productivity gains will justify today's high prices in tomorrow's earnings. Now here is where it gets uncomfortable. When you walk through your neighbourhood, that is not what you feel. You feel people stretching. You see friends juggling extra jobs just to keep up. You hear about landlords raising the rent by hundreds of dollars because the market has moved. You see co-workers quietly putting groceries on credit cards and hoping next month will be better. That disconnect is the whole point. The stock market is not designed to reflect your life this month. It is designed to reflect what big money expects over the next few years. And the machine has powerful tools to push those expectations around. To really see why it has not broken yet, we need to look at a time when it did. Think back to 2008. Back then, the story was that housing never goes down nationally. Banks were packaging up risky home loans, stamping them as safe, and selling them all over the world. People were buying second and third homes with tiny down payments. On the surface, it looked like a golden age. New houses, easy credit, rising stock portfolios. Underneath, everyday people were actually getting weaker. They were stacked with debt they could not afford. Their job security depended on a housing boom that could not last. When the bubble burst, it was not just stock tickers that bled red. It was families losing homes. It was people walking into work on a Friday and leaving with a cardboard box. Retirement accounts were cut in half. Unemployment spiked. One crisis took years to clean up. What did the machine do? They panicked. They cut interest rates all the way down near zero. They bailed out the biggest players. They started buying bonds on an industrial scale. They essentially said, "We will not let the system reset fully. We will pump air back into this balloon." Fast forward to the pandemic crash. Again, record speed collapse. Again, massive intervention. The central bank did not just cut rates, it backstopped credit markets, bought all kinds of bonds, and helped to launch huge government stimulus. The result was the fastest rebound from a crash in modern history. So when people ask, why has the market not crashed yet? One answer is ugly but honest. Because they have not allowed a full reset since 2008. Instead, they keep kicking the can. Every time the system wants a deep clean, they spray air freshener. And while they spray the air freshener, they tell you everything is under control. Meanwhile, in the background, smart money is not buying that story. Look at one of the most famous investors on the planet. His company has been sitting on a huge pile of cash in the last couple of years, while quietly selling more stocks than it buys. That is not what you do when you think everything is cheap and safe. That is what you do when you are patiently waiting for better prices. So on television, you hear, markets are fine, long-term optimism, stay fully invested. But behind the scenes, some of the smartest capital allocators alive are basically saying, prices look rich. I would rather have dry powder. Watch what they do, not what they say. The same thing is happening on the other side of the world. China spent years building like crazy. Whole new districts, endless apartment towers, massive developments. For a long time, people called them ghost cities. Millions of apartments sit empty or underused, a giant oversupply built during the boom years. People poured life savings into extra homes because there were not many other safe investment options. It felt like a one-way bet. Sound familiar? That is the echo of the housing excess before 2008, just in a different country, amplified by a different system. So we are in this strange position. On one side, you have years of cheap money baked into asset prices, big pools of forced buyers like pensions and index funds, and a central bank that has repeatedly stepped in to stop full-blown collapse. On the other side, you have stretched families, hidden fragility, and smart money behaving like something is off. So why has the crash not come yet? Because full crashes are not just about high prices. They are about forced sellers. They are about everyone needing cash at the same time. As long as jobs are mostly intact, as long as credit still flows, as long as the big forced buyers keep buying every month, the market can stay overvalued for a very long time. Valuations can look crazy for years before they break. The danger is thinking, because it has not crashed yet, it never will. Because it is not a question of if, only when. That line is not meant to scare you. It is meant to change how you prepare. If you play this game like a gambler, you spend every month either terrified of a crash or hoping for one so you can go all in. If you play it like a strategist, you accept two truths at the same time. One, you cannot predict the exact day the floor gives way. Two, you can absolutely control how prepared you are when it does. So what does preparation actually look like for a normal person? Not a billionaire. Part 1 is your storm prep. This is the boring part you do before anything breaks. Building what I like to call crash cash. Not in the sense of hiding everything in a savings account, but having a portion of your net worth in truly safe, liquid form. Money you could deploy if stocks went on a clearance sale without blowing up your ability to pay rent or feed your kids. It is also tightening the obvious leaks. High-interest credit card balances that eat you alive every month. Useless subscriptions. Lifestyle creep that turns every pay raise into another fixed bill. Every dollar you stop wasting in the fake boom is a dollar that can become opportunity money during the bust. The machine wants you stretched and desperate when things finally crack. Because desperate people sell at the bottom. Your job is to be the opposite. Part 2 is your crash playbook. This is where you decide, in calm times, how you would behave in ugly times. Not what exact ticker to buy, but what kind of assets you actually understand and want more of if their prices fall. Maybe that is broad index funds. Maybe that is a handful of strong companies you have researched. Maybe it is simply paying down your mortgage faster when rates drop again. You write this down, you keep it simple, and you promise yourself you will follow the plan in layers. Not, I will dump everything in on the first big red day. More like, if the market falls 20%, I am comfortable deploying this slice of cash. If it falls 30%, I can add more. If I lose my job, I stop buying and protect my emergency fund first. That way, when the headlines scream and everyone around you is refreshing their portfolio in a panic, you are not guessing. You are not asking strangers on the internet what to do with your life savings. You are executing a plan you made back when your hands were steady. And here is the twist. Even if the big crash takes longer to arrive than anyone expects, that same discipline still helps you. Dollar cost averaging through the noise, keeping your basic life stable, avoiding dumb leverage, and unpayable debt. None of that is wasted just because the market floats higher for a while longer. The machine needs you confused, emotional, and short-term focused. You are choosing to be the opposite. You are learning to see that the reason the stock market has not crashed yet is not that it is invincible. It is that it has been held up by years of cheap money, constant inflows, and fear of letting the system truly reset. That support can last longer than feels reasonable, but not forever. So instead of trying to guess the exact week the music stops, build a life and an investing approach that does not depend on perfect timing. Use the fake calm to quietly strengthen your position, so that when we finally get another 2008 moment or another 2020 style air pocket, you are not the one getting wiped out. You are the one calmly picking through the clearance rack. Thanks for watching, and if this helped you feel a little less crazy and a little more prepared, make sure you stay tuned, keep learning, and keep thinking for yourself. The machine is not going to suddenly start telling you the full truth. That part is on us. And a final reminder, I am not a financial advisor, and this is not financial advice. This video is for educational and entertainment purposes only.